Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous?
It's Friday. Welcome to Modern Investing Techniques, episode 88. I'm Patrick in Vancouver. Today is June 26, 2026, last trading day of the week. Let's review the week and set up for next Monday. Quick reminder, everything we discuss here is for education and entertainment. The practice investment of the day uses simulated trades with no real money. I'm not a licensed financial advisor, and this isn't financial advice. Always do your own research before putting real money to work. Tech outflows hit a 3-month high as AI infrastructure cost concerns triggered $2.9 billion in fund redemptions, giving TFSA holders a chance to reassess concentration in names like SoftBank and Apple before next week's open. The S&P 500 closed at 7,357 and finished flat. The Nasdaq Composite closed at 25,359 for a loss of 0.5%. The TSX Composite closed at 34,850 for a gain of 0.3%. Broad tech selling accelerated after SoftBank dropped on OpenAI and IPO delay reports, and U.S. equity funds saw their first net outflows since March. The ECB rate hike probability for 2026 has been cut below a quarter point as sliding oil prices ease inflation fears. Are we beating the Nasdaq this week? Our simulated portfolio posted positive cumulative alpha of 11.0% across 30 benchmarked trades, while the broader index moved lower. With capital clearly rotating, let's examine the exact playbook investors are using right now. Intense rotational plays involve shifting capital between sectors or themes based on short-term catalysts rather than long-term buy and hold. Today's data shows exactly why this matters. U.S. tech funds posted record withdrawals while Citizens upgraded Uber on Waymo momentum and reiterated outperform ratings on Nacional and PNN Entertainment. The approach works by identifying where capital is rotating next using analyst target changes and volume spikes instead of chasing yesterday's winners. Implemented by screening for stocks with fresh 12-month target increases from multiple brokers and checking 5-day relative volume above 150% of the 20-day average on platforms like Interactive Brokers or Questrade. Historically, rotations have delivered the strongest alpha in the final 6 to 8 weeks of a quarter when macro data shifts. They carry whipsaw risk if the catalyst fails to materialize. The key is requiring at least 2 confirming signals, analyst action plus volume, before committing capital. That same rotation logic is exactly why we're testing it live in today's practice trade. This is a simulated trade for educational purposes only. Today's practice investment is Uber Technologies on the NYSE. Citizens raised Uber's price target, citing accelerating Waymo robo-taxi growth momentum. The stock has pulled back with the broader tech sell-off. We are watching for a reclaim of the 20-day moving average on volume above the 20-day average. The stop loss sits 6% below entry to account for continued AI-related rotation out of growth names. The target is plus 4% to plus 7% over the 5-day hold. Confidence is medium because we have 2 confirming factors in the fresh analyst target raise plus sector rotation signals. This setup demonstrates how to use broker target revisions as a filter rather than a standalone signal. It also shows the value of waiting for rotation into a name instead of chasing the prior week's leaders. Before we check how yesterday's trade fared, here's the hard lesson it delivered. Last flash trade was MU on an AI momentum entry with volume confirmation. We entered at $1,233 at market open and exited at $1,213.56 at market close. The position lost 1.58% or $15.77 on a $1,000 position. The earnings revision catalyst faded faster than expected once broader AI infrastructure cost concerns resurfaced. The trade lost 1.58%, while the Nasdaq fell 0.5% on the same day for negative alpha of 1.08%. The new rule requires closing price confirmation before declaring any catalyst trade complete. That discipline pairs directly with understanding how ETFs can quietly cost you money at the open. Imagine you bought the new eFund HKEX Tech 100 Index, ETF ticker 3456, on its listing day at a 1.2% premium to NAV because retail demand surged. Your order filled at that premium, but the actual underlying Hong Kong tech stocks traded flat. The mechanism that matters is the creation and redemption process. Authorized participants can create new ETF units by delivering the basket of stocks or redeem units for the underlying, which keeps the price within a tight band around NAV. When demand spikes, the premium can widen to 1 to 2% intraday before arbitrageurs step in. That 1% difference on a $50,000 position equals $500 left on the table if you sell before the premium compresses. Most retail investors don't realize they can check real-time premium and discount data on the ETF issuer site or Bloomberg terminals before placing a market order. The biggest mistake with new ETF launches is buying at the open without checking the indicative NAV. Instead, always place a limit order at or below the last reported premium level. While we're on tools, 2 new resources worth watching this week. The eFund HKEX Tech 100 Index ETF, ticker 3456, tracks 100 Hong Kong listed technology companies and trades on the Hong Kong Exchange. It gives Canadian investors direct exposure to the region without individual stock selection and offers a low-cost way to add emerging market tech diversification inside a TFSA. Use it via any broker with HKEX access, such as Interactive Brokers, and compare its premium or discount to NAV daily. The Polymarket platform suffered a $2.9 million front-end compromise, but contained the breach and will refund affected users. Active traders can treat Polymarket volumes as a sentiment gauge for macro events like rate decisions, while keeping position sizes tiny given custody and smart contract risks. A few more quick analyst moves to note before we wrap. Citizens maintains safe hold at market outperform. The REIT received a reiterated outperform rating from the same firm. That action signals continued institutional interest in specialized real estate plays. Broader tech rotation is occurring at the same time. The rating arrives while other growth sectors face outflows. Investors can add SAFE to a TFSA watchlist. They should wait for a test of the 50-day moving average before considering an entry. The move reflects steady demand for niche property assets despite market rotation. European gas prices sit near 2-month lows. Normalized shipping has pushed TTF gas futures to their lowest levels since late April. The decline reduces energy cost pressure on European industrials. Lower prices ease input expenses for manufacturers across the region. Traders can trim any European energy ETF exposure. This step applies if holdings exceed 5% of the portfolio. The futures data shows how supply normalization directly affects commodity benchmarks. Accor was downgraded to hold at Jefferies. The Middle East RevPAR collapse triggered the cut. Regional revenue shocks can hit travel names quickly. The downgrade highlights vulnerability to specific geographic downturns. Investors should avoid adding hospitality exposure this week. They can wait until RevPAR data stabilizes. The rating change demonstrates how localized metrics drive analyst decisions in the sector. Biomiriu rises on an FDA submission. The vaginitis panel filing lifted shares. Regulatory catalysts can still move healthcare names even in a risk-off tape. The submission illustrates how approval milestones create short-term momentum. Investors can watch BMXMF for a sustained move above the 20-day moving average. They should consider adding only after that level holds. The price reaction shows healthcare stocks responding to pipeline updates amid broader selling. Finally, put today's lesson into action with this week's listener challenge. Open your brokerage platform, pull up the Uber options chain for the July monthly, and calculate the premium you would collect selling the 5% out of the money call. Note the implied move and decide whether that yield justifies the risk for a simulated position. Our simulated portfolio has completed 41 trades with a 51% win rate. Cumulative profit and loss stands at $263.15. Average return per trade is 0.64%. The best trade reached plus 20.11%, and the worst reached minus 11.80%. Our AI analysis is learning from valuation discipline patterns and adjusting position sizing accordingly. Before we wrap, watch for Monday's open to see whether Uber reclaims the 20-day moving average on volume. That's it for today's Modern Investing Techniques. The resources page has links to everything we discussed. Subscribe and share with someone who wants to go beyond index funds. See you tomorrow, and if you'd rather watch than listen, find us on YouTube at Nera Network. Links in the show notes. And before you go, this show is part of the Nera Network, a family of daily podcasts on tech, science, and markets, each one a short, sharp briefing you can finish on the commute. If today earned its place in your feed, here's your next listen. Tesla Shorts Time, your daily deep dive into everything Tesla. Find every show free at neuranetwork.com. This episode used AI voice synthesis of my voice. Editorial selection and analysis are my own.
Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous? Do you ever stay awake, counting sheep like all the time? What's your life like? What's your purpose? When's your birthday? What's your sign? Are you down right now? Are you stuck up in the past? Are you still thinking about all the times that you didn't last?